Don't choose investments based upon which ones grow to the most. Choose investments for retirement based upon which ones will generate the most at the time in life you're going to need the money the most. In this episode, I'm going to answer the question, why does an IUL take 5 years to break even? So get ready. I'm going to share some insights that maybe you have never considered before. I'm Doug Andrew. I've been a financial strategist and retirement planning specialist for more than 46 years. I used to have 3,000 clients in 13 Western states invested in the market with all kinds of mutual funds. I was a big buy term invest the difference proponent back then. That was from 1974 to 1980. And then everything changed and my clients were never happier than when I got them out of the volatile market and into max funded universal life. Because universal life was born, it was conceived by E.F. Hutton, who was not an insurance company. They were credited with being the original brainchild behind the emergence of universal life back in 1980. Up until 1988, I had clients that could come in and fund their universal life policy in one fell swoop. I had many clients, for example, throw in a lump sum of $500,000. And back then, interest rates were high. The general account portfolio rates of the insurance companies on all their bonds, AA and AAA bonds, mortgages on skyscrapers and shopping malls and so forth, were up there in the double digits. So I never earned less than 11.75%, up to 15.5% from 1980 to 1990. But because I maximum funded the contract right off the bat, we hit the ground running with those policies. If I earned, let's say 11, I netted 10. Only one of the percentage points was necessary to pay for the cost of insurance in order to generate tax-free income. I took the least amount of insurance the IRS would let us get away with, and I put in the most premium as the IRS would allow, and they allowed back then lump sum deposits. That was true from 1980 to 1988. And so people would put in $500,000, and if they were retired and they wanted immediate income, they could start pulling out that 10% that they were netting immediately. That would be 50 grand a year of tax-free income. Well, if you've watched other instructional educational videos that I've done, you know that the banks and the brokerage firms lobbied Congress back in 1988. They sort of went, that's not fair. We can't compete. You've got to slow the flow, but they didn't want to kill max-funded universal life insurance contracts for tax-free accumulation, tax-free access, and tax-free transfer, because that's where they put some of their Tier 1 assets. In fact, many banks, credit unions, put 30 to 40% of their Tier 1 assets for liquidity and safety into max-funded insurance contracts. They borrow our money the last couple of decades at as low as 1%. They pay us 1% to put money in a bank. They turn around and put 30 to 40% of that money into BOLI, bank-owned life insurance, and they earn 5% on the general account portfolio. How much more is 5 than 1? It's 500%. It's not 4. Would you hire an employee for 10 grand if that employee made you an extra 50 grand? That's what banks have been doing. But they couldn't compete. And so back in 1988, they lobbied Congress and says, don't destroy these, because this is where they put some of their money. Let's slow the flow, because people were coming and when they saw the liquidity, the safety, the rate of return, tax-free benefits, and then when you ultimately died, $500,000 would blossom for a 60-year-old to $1,250,000 and transfer tax-free. So there's not a mutual fund or a bank CD around that could do that. And so they were afraid there would be this massive exodus of money leaving their institutions, and it was happening from 1980 to 1988. So they passed in 1988, June 21st, the Technical and Miscellaneous Revenue Act, which had provisions, by the way, that's an acronym. This stands for TAMRA, T-A-M-R-A. And TAMRA said that from June 21st, 1988 forward, if you funded a universal life in one fell swoop at the maximum guideline single premium, taking the least amount of insurance the IRS will let you get away with under the TEFRA and DEFRA tax citations of 1982 and 1984. And if you don't know what I'm talking about, make sure you search on my channel for YouTubes that educate you on TEFRA and DEFRA. But if you funded it in one fell swoop after that date, anybody before that date was grandfathered. You didn't have to comply. You had tax-free income. The money would grow tax-deferred if you violated TAMRA. If you died, it would blossom and transfer income tax-free. But if you started taking income, like that 50 grand a year in that example, it would be taxable LIFO, last in, first out. You would have to start paying tax on the interest, which is the way annuities are taxed. And so if you wanted to have tax-free income after June 21st, 1988, you had to comply with TAMRA by spreading out the funding. Now with universal life, you can do that in 5 installments. And if you make your first installment, let's say it's a $500,000 guideline single premium into that indexed universal life, or a regular universal life policy. You could put in 100 grand approximately if you're over age 50. If you're under age 50, you could put in even more than that. But let's just round it off. So you put in 100,000 the first day of the first year, you can put in another 100,000 the first day of the second year, and so forth. So in 4 years and 1 day, you could comply with TAMRA and have your whole 500,000 in there. And now you're grandfathered forever after to be able to have tax-free income because you complied with TAMRA. That's the 5-year or the 5 payment. Now, whole life, they have to spread it out over 7 years. And that's one of the reasons I like universal life over whole life, is because you can get in the money faster. You can get away with less insurance. And basically, universal life was designed for living benefits. I can earn 11 and net 10. I can earn 9 and net 8, where most whole life policies only credit you maybe 4 or 5 or 6%. You're lucky to net 2 or 3% cash on cash rate of return with whole life because it was designed primarily for death benefit. So that is TAMRA. Now let me share with you and use an analogy to show you what you have to do to be patient, because you don't choose investments for long-term goals based upon which ones grow to the most. You choose investments based upon which ones generate the most, the income at the time in life you're going to need the money the most. So in the various books that I've written regarding these universal life insurance contracts, and my most recent book is called The Laser Fund, I often use an analogy that my son came up with of a 5-story building, okay? So this type of insurance policy can be compared to owning an apartment building or running your own business, let's say. So let's say you have a 5-story building here. Now, your goal is to fill up the building. You want to lease it out. You want to rent it out. But this law that was passed in 1988, because the banks and brokerage firms demanded it, sort of, in my opinion, is ridiculous. But you know what? We have to comply. So it means they would only let you lease out 1 floor at a time, but see, it behooves you to fill it up all the way, and that's when it turns into a cash cow. So let me show you, based on TAMRA, if you fill it up all the way, it grows tax deferred. If you die, it blossoms and transfers tax-free. But if you start taking income out, you now have to pay tax on a life last in first basis. In order to have total tax-free income for life on these, we have to fill it up 1 floor at a time, 1 year at a time. So this is dictated under this TAMRA law, Technical and Miscellaneous Revenue Act, and we take the least amount of insurance the IRS will let us get away with under the TEFRA and DEFRA tax citations of 1982 and 1984. So under Section 72E, 7702, and 101A of the Internal Revenue Code, our money will grow tax-free. We can access it tax-free. And when we ultimately die, it blossoms in value and transfers income tax-free, because nothing else in the Internal Revenue Code does that. When we use the building analogy, at the end of the acquisition phase, this is where you're getting your insurance contract established to accommodate, let's say $500,000. There's nothing magic about that number, but it's a good example here. The most you can put in is about 1/5 if you're age 50 or older. So that would be $100,000. You can put that in the first year. If you put in more than that, the insurance company should refund it back to you so that you don't bugger up the tax-free access that you're using. Now, if you're just doing it for death benefit, it doesn't matter, because when you die, it is tax-free. So what happens is in year 2, you put in another 100,000, year 3, another 100, year 4, another 100. And so you're taking 4 years and 1 day to fill up your building. And it just reasons that when the building is only 20% full or 40% full, it's probably not covering your costs. That is true with an insurance contract. You cannot cover the cost of insurance that is required by the IRS 100% just from having your account 20% funded. And so as you fill it up, you're now able to have this cash cow, because once you've maximum funded your insurance policy, it's like leasing out the entire building. And once you're 60% full, it starts to really make money in a building or a rental property. That is true with the insurance contract. So during the first 5 years, it may not look very impressive because we have to comply with these TAMRA rules. You have to jump through these hoops, so to speak. Once you do that, it's often compared to a bucket. So under TEFRA, DEFRA, and TAMRA, the first year, if I put in 20%, if I don't have to do that, but if I maximum fund in this example, if the total was 500,000, I wanted to be grandfathered to put in here, the fastest I could put in would be 100,000, and then another 100, and then another 100, and then another 100, and in 4 years and 1 day, the last 100 goes in. Now I have the 500,000 in. And even though the spigot on the bucket, which is the cost of the insurance that the IRS says has to be there in order for it to be tax-free, we want the spigot to drain out a smaller and smaller amount as your money grows in the policy, which I explain in other YouTube videos. So then it starts turning into a cash cow. So what you do is you choose long-term investments that will generate the most, because in every illustration, once we comply with this, and it turns into a cash cow, this thing knocks the socks off of other types of traditional accounts like IRAs and 401ks that are going to be taxable when you take it out. And this is where, as the older you get, the insurance can get cheaper. This spigot on the bucket gets smaller and smaller. The IUL policies that I've had for 20 and 30 years, they cost 1/20th what they did when I first took them out, even though I'm older, because my cash value now is part of, or 95% of, the death benefit. The interest on all this cash is more than covering that spigot on the bucket. So if I earn 11% this year, I'm netting 10.9 or 10.95. But during the average of, let's say, 30 years, even with those first 5 years while you're filling the bucket to comply, the net rate of return, if I earn 11, I net 10. Only about 1% drains out that spigot on the average. And so if you're going to use a universal life policy for long-term goals, make sure you don't act like it's a drive-up window at a bank, a put-and-take account. No, this is designed for long-term, and it will generate, if you have $1 million in here, you'll be able to take out up to $100,000 a year of tax-free income into perpetuity. Show me anything else that can do that on a tax-free basis, because I did it for the tax-free income, not for what it grows to when it's only 20% or 40% funded. Does that make sense? So when we look at a long-term goal like retirement, you want to make sure you choose the vehicle that will generate the most after considering the negative impact of taxes, inflation, market volatility. That's why I like indexed universal life, because it's tax-free. I eliminate the danger of taxes going up. Inflation, I link my returns to the things that inflate. So inflation, even though I don't like it, doesn't hurt me, it helps me. And also I eliminate the danger of market volatility, because I get to participate when the market goes up with indexing, but when the market goes down, I don't lose. So if this is intriguing interest in you, I would ask you to get a copy of this book. Now, I will gift you this book. If you go to laserfund.com, and you contribute $5.95 towards the shipping and handling, I will pay for the book and send it out to you. This is 300 pages of charts, graphs, and explanations. There's also 12 chapters in here on the reverse side of actual client stories, where you'll see actual numbers of how we have helped people do this for long-term goals and you will see the magic behind how complying with TAMRA in the long run generates the most net spendable tax-free income so that you do not outlive your money.